why and when to convert to a Roth IRA account. We'll talk a little bit more specifically at the end of the presentation about if you're converting or looking to convert assets held within a self-directed IRA, because it's a little bit different process involved when you're converting a piece of real estate or a note, mortgage, something like that. But in this case, we're also going to spend a good deal of the first part of the webinar today talking about why and when would you convert to a Roth IRA from the outset, and what goes along with that process. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now. I spend most of my time talking with potential new clients, educating individuals about self-directed IRAs in general. And again, today's webinar is a little more specific in talking about Roth IRAs and how to convert assets held in a pre-tax IRA, like a traditional IRA or 401k, and get that money growing tax-free for you within a Roth IRA account. Now, as we go through the presentation today, if you have any questions, if you're watching live, please type your question into the chat box on your screen. I'll make sure I get to those questions when they come up. If you're somebody who's watching a recorded version of today's webinar, just write down your question as you go along, and at the end of today's webinar, my contact information will be on the screen. You can certainly email or call me with any additional questions you have at that time. Now, one quick disclaimer on Advanta IRA: we do not provide any investment advice. We do not endorse any products. And as we talk today, we also don't give any legal, investment, or tax advice. So when it comes to making an investment within your self-directed IRA account, our job is to evaluate it and make sure the investment gets properly titled, make sure that you as a client have approved of the transaction, but we are not going to actually give any advice as to whether or not you should or should not enter into a transaction. And certainly as we talk today about doing a Roth conversion, that's a big tax decision for any individual thinking about moving money from a pre-tax account into a tax-free Roth IRA. We do very heavily suggest getting your tax advisor, your accountant involved with that decision so you can see what impact doing a conversion is going to have on you as you go forward. So today's agenda, we'll talk a little bit about the history of IRAs, where they started, where they came from, go over IRAs just in general, and then we're going to spend most of the time again talking about what a conversion is and what the rules are. What's involved when you're moving money from a tax-deferred account like a traditional IRA into a Roth, what the rules are, what the tax implications each person will have. And I mentioned we'll talk at the very end about what's needed if you're looking to convert assets that you already hold within a self-directed account. What's needed in order to make a Roth conversion of those different assets like a piece of real estate or a mortgage? What's involved in getting those assets moved from a traditional tax-deferred IRA into a Roth? Now, just a quick background on the history of IRAs and where they came from. Well, traditional IRAs, what we would refer to today at least as a traditional IRA, those accounts were actually created back in 1974. They were created under the ERISA Act, but it was enacted back at that time. And IRAs were really designed initially for two individuals, I should say, with two sets of circumstances that they were dealing with. At that time, prior to the creation of an IRA, a lot of individuals who had retirement accounts had those retirement accounts in the form of a pension plan through their employer. So you worked for a company, they offered you a pension plan, you were able to then make your contributions, that money was growing tax deferred, and one day down the line, you'd be able to collect on that pension benefit when you retired. That kind of the way the retirement plan system was at that time kind of created two issues I mentioned for individuals to deal with. One, if you worked for a company and you had that pension plan. So I was working for ABC Company. I had my 401, I had my pension plan through them, and I retired. My pension simply stayed there. There's nothing I could do to increase the value of that pension. I couldn't contribute any more to it. So that was one issue. The other issue was that a lot of individuals simply didn't work for companies that offered pension plans. So if I wasn't fortunate enough to work for a company offering a pension, I had no similar vehicle to actually save for my own retirement account. So in 1974, by creating an IRA, an individual retirement arrangement, it allowed for individuals who didn't have a retirement plan to start contributing for themselves on a tax-deferred basis. And it also allowed for individuals who were covered under a pension plan when they left their employer the ability to take that money and roll it over into an IRA and then begin to grow the money as they wish and kind of forego their pension benefit. We see a lot of rollovers today in the form of individuals have a 401k, and 401ks largely replaced the pension plans in this country. The pension is referred to as a defined benefit plan, meaning that company said we are going to give you X number of dollars when you retire per month. It was up to the company to make sure that that money was indeed there for all of their employees they promised those benefits to. Those are defined benefit plans. 401ks and 403b plans are referred to typically as defined contribution plans, where the company will define and tell you how much money they're going to put in initially for you, but it's up to you to make decisions to actually grow that account. So more and more companies have gone away from the defined benefit plan and have replaced them with 401ks and 403bs. And those accounts as well, those 401k plans can also be rolled over into a traditional IRA. So from 1975 till about 1997, there was a traditional IRA. They also enacted a SEP IRA and a simple IRA for small business owners to contribute their own money. But all those accounts were tax deferred, meaning that the investments you made contributions into the IRA account, the money grew tax deferred. You didn't pay taxes as you invested and reinvested. But when you pulled the money out, you were taxed at that time. So you were basically, the money was included in your income when you reached retirement age. Well, in 1997, Senator Roth from Delaware proposed a new type of IRA, one in which you could make your contributions after tax. So you did not get a deduction up front for your contribution, but the benefit in foregoing your deduction was that ultimately the money was going to grow tax-free, and when you reach retirement age, the money would come out to you without any impact on your taxes whatsoever. When that new type of IRA was passed, it took the name of its founder, Senator William Roth of Delaware, and what we know today as the Roth IRA account. So Roth IRAs have been in existence since 1998 was the first year you could actually make a contribution to a Roth account. And just one other thing of note when it comes to Roth accounts, in 2006, as part of President Bush's tax cut program in 2001, part of those provisions allowed for a Roth feature to be involved in a 401k plan. So anyone who's involved in a 401k plan can actually elect their salary deferral to be made into a Roth 401k rather than just a simple, regular, kind of more traditional 401k plan. I'll talk a little bit about the types of IRAs in general, just a traditional IRA at a quick glance. This, again, is your most common type of IRA. It's been in existence the longest. And we see a lot of traditional IRAs still to this day because individuals, when they leave an employer, whether it be a private company or maybe the local school board, local county government, they're able to take those retirement accounts, those 401ks, the 403bs, the 457 plans, and roll those simply into a traditional IRA with no tax consequence. Now again, the benefits that a traditional IRA offers is that, one, you get a deduction typically for any contributions you make to a traditional IRA. You actually get a write-off on your 1040 in a given year, and the funds within those accounts are going to grow on a tax-deferred basis. So as you are investing and reinvesting with a traditional IRA, you don't pay taxes. You don't pay capital gains, you don't pay income tax, and the benefit is it allows you to compound your money more quickly when you're not paying taxes at each step of the way. Now with a traditional IRA, when you reach retirement and you start pulling money out at that time, that's the point at which you were actually taxed on the growth and the income within that particular IRA account. Now, one thing of note is if you do want to make contributions to your traditional IRA, again, in most cases, you get a deduction for your contribution. So if I put my $5,000 or $5,500 a year into my traditional IRA, I most likely would get a tax deduction for making that contribution. Now, there is some times though when you would not get the deduction. This is the time, again, when you would think instead about making a contribution to a Roth IRA. If I was a single individual and my modified adjusted gross income was over $71,000 a year, and I am covered by an employer's plan, which means I work for a company that offers a 401k, if I went to make a contribution to my traditional IRA, I would not get a deduction for making the contribution. Similarly, you can see if you are married, filing jointly with your spouse, there's a different modified adjusted limit when you take into consideration both spouses' income. And also there's different limits if your spouse is actually the one who is covered by the employer plan as well. What that means simply, and again, these numbers aren't important to remember because your CPA, your tax advisor should have those. But if you are covered by an employer's plan, you may not be able to deduct your contribution to an IRA, or traditional IRA, I should say, in a given year. It might be a situation where you would look to instead actually make those contributions to a Roth IRA if you're not going to get a deduction. Now, with traditional IRAs, you're taxed at ordinary income. Once you reach age 59 and a half, you can start pulling the money out of the account without any penalty. Now, if you're prior to 59 and a half and you want to take a distribution from your traditional IRA, you're hit with a 10% penalty for an early withdrawal on the amount that comes out, as well as have whatever you pull out be subject to ordinary income. But at 59 and a half, that 10% penalty goes away, but you can still take money out if you wish. You don't have to at 59 and a half. You just are able to take it out without penalty. With the traditional IRA, the key thing, and a lot of individuals who get close to this age realize this starts kicking in, is at age 70 and a half. The IRS requires, if you have any kind of taxable retirement account, whether it's a traditional IRA, a SEP, a 401k, at 70 and a half, you are required to start taking a minimum distribution. If you look at it from the standpoint of the IRS, these accounts, these traditional IRAs, have been growing on a tax-deferred basis for a number of years. There was never any tax collected from the initial contribution all the way through the earnings. At age 70 and a half, they require you to start taking a distribution and start paying at least some of the taxes due back to that money. And you take a distribution at age 70 and a half and each year thereafter. And that required distribution typically is between 3 and 4% of your overall value of your taxable IRA accounts. Now, there are exceptions if you wanted to or needed to take money out prior to age 59 and a half. If you're taking your money out from your traditional IRA for the higher education expenses for you or a dependent, if you're disabled or you're a first-time home buyer, you can actually pull certain amounts of money out of that traditional IRA and not pay a penalty, but you would still be subject to the tax. Now, the Roth IRA, again, we'll spend the rest of the time here now talking about the Roth IRA. The Roth IRA works the inverse of a traditional IRA account, in that when you make contributions out of your pocket to a Roth IRA, you do not get any deduction for making that contribution. Now, the benefit then of the Roth IRA, and hopefully everyone on the call, the reason why you're tuning in is because you know about the Roth or want to learn more about the Roth, but most people are familiar with the fact that a Roth IRA is a tax-free IRA, meaning that you make the contributions into the account, you don't get a deduction, but the benefit is the money is going to grow tax-deferred. You not pay tax again as you invest and reinvest, and when you reach retirement age and you pull the money out at that time, the money comes out to you completely tax-free. And that's why the Roth IRA is so powerful. It's why it's so favored and held in such great esteem by financial advisors and CPAs, is the nature of that money in that account is all going to be tax-free to you. You don't have to worry about what tax rates will be in the future, what tax bracket you might be in. The money is going to be coming out to you completely tax-free. Now, with a Roth IRA, though, there is a phase-out. There's a certain amount of money if an individual makes if their modified adjusted gross income is over a certain limit, you cannot contribute directly to a Roth IRA. They eliminate your ability depending on your modified adjusted gross income. So if you're single and you make over $131,000 a year, you cannot contribute directly to a Roth IRA. If you're married filing jointly, you'll see that if your adjusted gross income between you and your spouse is over $193,000, you cannot contribute to a Roth IRA account. The IRS, regardless of your willingness to put the money in, they simply will not allow you to make that contribution. Now, we'll talk about a workaround to this in just a moment, because while there is a restriction for making contributions to a Roth, as we'll see in just a moment, there are no restrictions for doing what's called a conversion, which we'll talk about in just a moment. Now, Roth IRA distributions, as long as you are over 59 and a half, and as long as you've had a Roth IRA for at least 5 years, everything you pull out of that account will be completely tax-free. And again, the thing is that you have a Roth IRA open for at least 5 years. So if you have Roth money in a Schwab account that's been there for 6 years and you move that money to an Advanta account or to a Fidelity account, you do not restart your 5-year clock. I just want to make sure that's a question we do get from time to time from individuals. You have similar exceptions. If you take money out prior to 59.5 with a Roth, you may be subject to an early distribution penalty of a 10%. But there are exceptions to that 10% penalty as well for the first-time home buyers, the disability, or if you're doing qualified education expenses for yourself and a dependent as well. With kind of a difference here between the traditional and Roth IRAs, again, the traditional offers you the tax deduction for making the contribution if you're eligible. The Roth IRA does not. That's kind of the one the negative against the Roth IRA is not getting the tax deduction up front. They both are going to get tax deferred growth, and the fact that as you invest and reinvest within the account, there's no taxes due. But again, as long as you're 59.5 and you've had a Roth for at least 5 years, your money's actually growing tax-free, and you can start pulling it out without paying any income tax whatsoever. Now, because a Roth IRA is not taxed when the money comes out, the IRS does not have any mandatory withdrawals. So I mentioned with a traditional IRA accounts at 70.5, you're required to take a minimum distribution. With a Roth IRA, because there is no tax revenue to be realized, the IRS does not care if you ever take that money out or not. You can actually leave your Roth IRA, will it to your heirs. They will take the money out over the course of their lifetime on a tax-free basis as well. Now, one question I've received from time to time when it comes to Roth IRAs, are people concerned that the IRS or the government is going to get rid of Roth IRAs, or at least get rid of the ability to make contributions or conversions to a Roth IRA? My general personal feeling is that this would not happen. I guess anything is possible, but at least this is the reasoning behind why I think it's less likely that that will ever happen. You'll see this on the slide. If we were to take 100 individuals who are looking to make a $5,000 contribution to an IRA in a given year, and they could do it either to a Roth or a traditional, whichever they choose will have a different impact then on the amount of tax revenue the government receives in a given year. Now, if you had 100 individuals all making that $5,000 contribution to a traditional IRA account, that's going to result in $500,000 worth of tax deductions, right? So each 100 individuals each of those individuals is taking a $5,000 deduction. So for the total of $500,000 deductions, if the average taxpayer's rate is 20%, and again, I'm not sure where these 100 individuals would fall, but we say the average rate is 20%, that'd be $100,000 less in actual tax revenue that the government would receive in that particular given year. Now take that $100,000 of actual less revenue and multiply that by the number of people who actually make those contributions. The IRS obviously is going to receive tax down the line when somebody retires, but as far as right now, the government will have less tax revenue to actually spend on various products and programs. If you take that same contribution and have those 100 individuals, if they're eligible, make those contributions to a Roth IRA account, there is no deduction up front. So the government, the federal government, the Congress, whomever, will now have $100,000 more in tax revenue now because there are no deductions if those individuals choose instead to make the contribution to the Roth. That's kind of one of the reasons I don't know that I would see Roth IRAs being eliminated or the ability to contribute, because I think our government, individuals in charge up there, would prefer to have that income now and revenue now to spend on current projects. I don't think they're interested in waiting and foregoing that benefit, knowing that they won't get it for much farther down the line. So it's kind of my little 2 cents on why I think Roth IRAs are at least here to stay, at least more likely to be here to stay. Now, getting into the kind of meat of our presentation today, kind of what is a conversion? Okay, again, we've talked about 2 types of IRAs so far: traditional or pre-tax, tax-deferred IRA, we call the traditional IRA, and also the tax-free IRA account called a Roth. Now, a lot of individuals, again, work for an employer, they work for a local government where they have money, they've built up money within a tax-deferred account like a traditional IRA or a 401k. They would prefer to have that money growing tax-free. They don't want to have the money staying in that account, growing, making good returns on a given year, knowing that they're eventually going to pay tax on money. They say, I'd rather get that money now into a Roth IRA account, knowing that the money is ultimately going to be tax-free. So the IRS does allow you to move money from a tax-deferred account, like again a traditional IRA, a SEP, maybe as simple an old 401k, put that money into a post-tax Roth IRA account. So they will let you say, oh, carve out whatever amount you want, move it from the tax-deferred account into the Roth IRA account. What they will have you do, though, as long as you're willing to pay the taxes now on what gets transferred over, you can do a conversion. When you do the conversion from the traditional to the Roth, then going forward, everything within that account is growing tax-free. So basically, in short, you're electing to pay taxes now on the money that's in the account rather than continue to have the money grow tax-deferred in a traditional IRA and pay taxes down the line. Now, the rules for converting from a traditional to a Roth. Now, prior to 2010, just go several years ago now, prior to 2010, the IRS had two different different rules for doing a conversion. One is that your modified adjusted gross income had to be less than $100,000. Now, we showed in the slide a little while ago that for contributing to Roth IRAs, your income for single had to be less than $131,000, and if you're married, $183,000 or $193,000. But prior to 2010, if your adjusted gross income was over $100,000, despite your willingness to pay the tax to do a conversion, it simply was not permitted under IRS rules. You were not allowed to do a conversion if that was the case. Additionally, when you did a conversion, the fair market value of the assets that you converted was considered as taxable income for that particular year in which you did the conversion. So if it's, here it is in 2015, I do a conversion, I will have all of that tax implication in this one particular given year. Now, after 2010, and the rules are now, is that adjusted gross income limitation of $100,000 was eliminated back in 2010. So if your modified adjusted gross income is too high that you cannot contribute to a Roth, you can always convert anything you have in a traditional IRA and move that money into a Roth account. So if your adjusted gross income is too high, you can make your contribution to a Roth and then in turn convert that money, make the contribution to a traditional IRA and then in turn convert that money to a Roth. It kind of is a workaround on how you can still get money into a Roth IRA depending on the amount of income that you actually have. And again, the fair market value of the conversion, again, is considered and is reported on a 1099 for the calendar year in which the conversion is done. You cannot go back and convert for prior years once December 31st has passed. That, again, is the key date to remember. It's why we're doing a webinar today towards the end of the year, is that if you want to do a conversion, you have to do it by December 31st of that particular tax year. Individuals who've had IRAs in the past or have IRAs currently and made contributions might be aware that you can actually contribute to your IRA up until April 15th of the following year and have it be retroactive for that particular year. So for instance, to make a contribution for 2015, I have actually until April 15th of 2016 to make my IRA contribution. But the key thing, again, with a conversion is it has to be done prior to December 31st. So when you meet your tax advisor in February to look over the previous year's tax implications, at that point it's too late to do a conversion. So it's a good reason and a good excuse to set an appointment with your tax advisor, your accountant here, prior to the end of the year and not miss a conversion opportunity. So again, just remember that the conversions must be done by December 31st, not April 15th. The amount of the conversion, so whatever you move from a traditional to a Roth IRA, is included in your taxable income and can bump you up to a higher tax bracket. So if I'm in a low bracket now at 10-15%, and I know that's all I'm paying, when I do a conversion, that could bump me up into the higher brackets. One thing people ask quite often is, when you do a conversion, what is the tax rate? How much tax do I have to pay on a conversion? Well, that's going to depend on what current tax bracket that you're in or and how much you're converting, if it's going to bump you up into a higher one. Now, any losses you have on your tax can certainly offset the amount of the income that you get from the conversion. Again, this is a reason why I suggest to people to go talk to your accountant in November or even later November, early December of a given year to make sure you don't miss an opportunity to do a conversion. If you ended up having a year where your income was lower or you had a lot of losses, it would be a great time to actually do a conversion and take advantage of those losses to offset the income that you would otherwise have from the Roth, from doing the Roth conversion. Again, you don't want to miss the December 31st deadline. The other thing just to remember is that you can undo a conversion. It's called a recharacterization. So if you do make a conversion, it's approaching the end of December, you decide, hey, let's go ahead, do the conversion. It looks like it's going to be a good idea for me to do it. And then you find out the following year when you're actually doing your tax return that maybe doing this conversion wasn't the best idea from an individual tax standpoint. You can recharacterize that conversion back to a traditional IRA. Basically undo it. The IRS just asks that you pull over the initial amount you converted plus any earnings that you had that was attributable to that particular the money that was over converted. And the deadline to recharacterize is actually October 15th of the following year. So why would you, or why would you want to convert to a Roth IRA, get this money growing tax-free? This is kind of a list of just some of the reasons. Certainly there might be more out there, but I think this encapsulates most of the reasons why people do it. Certainly if you're expecting larger returns on your investments in future years, it'd be much better for you to have your money growing tax-free rather than simply tax-deferred. So if I was expecting a large windfall on some investments, or at least the potential therefore, much rather pay the tax now on the lower amount, let those returns come in and grow tax-free rather than simply tax-deferred. Certainly people who have a longer time before retirement, it makes sense to do a conversion earlier on, simply because you have much longer period of time for your money to grow tax-free. If you're expecting that you will be in a higher tax bracket, or potentially that there will simply be higher tax rates in the future, you can go ahead and convert now and know exactly what you'll pay in taxes and not worry then about where you might find yourself in 20, 30 years with what tax bracket you're in or what tax rate you might be subject to. Again, if your traditional IRA contribution is not tax deductible, so if you were involved in an employer's plan and you make your contribution to a traditional IRA and realize that you're not going to get a deduction, you can always put that money first into the traditional IRA and then subsequently, immediately thereafter, convert it over to a Roth IRA. That would seem to make the most sense for me, is when you're doing a contribution that's not tax deductible to your traditional IRA to get that money moved over. If your assets within your IRA currently has depressed value, so if let's say you bought an asset for $100,000, but due to the current market conditions, that asset is really only worth $50,000 or $60,000 now, but you expect again maybe in the next 5 to 10 years that asset to not only get back to its original value, but grow from there. When you do the conversion is done at the fair market value at the time of the conversion. So if your asset has a historical value that's higher, for instance, usually the asset's around 100 or 120,000, but currently the value is at 50 or 60. The conversion and the taxes that ultimately would be paid would be based on that $50,000 or $60,000 lower value. Again, I mentioned if you have losses to offset the income, it certainly is a reason to convert because the losses are going to limit how much you actually pay in taxes. There's estate planning reasons as well. The fact that a Roth IRA will be left tax-free to your children or grandchildren, whoever your heirs are. A lot of people want to put that money into a Roth IRA and know that they're providing tax-free income then for their heirs. Now, one other thing, too, is the ability to pay any taxes due on the conversion with out-of-pocket money. When you do a conversion from a traditional to a Roth IRA, let's say I'm moving $50,000 from my traditional IRA into a Roth IRA account, the taxes are not withheld. The full $50,000 gets moved from the traditional to the Roth, and then I get a 1099 the next year for that conversion. And then when I put that into my tax return, if I owe any taxes, I would need to pay that with out-of-pocket money, my own personal money. If I reach into the Roth IRA to actually then pull the cash out to pay the tax, I would be subject to that 10% penalty for paying the tax with those funds in the Roth since it hasn't seasoned for at least 5 years. Now, a question came up on the chat box. Again, if anyone else has any questions as we go, please make sure you type them in there. I'll make sure I get to them. Question, is there a maximum amount that can be converted within a given year? And the answer to that question is no. The IRS, not surprisingly, would be fine with you converting whatever amounts you wish from your traditional or tax-deferred accounts into a Roth IRA. There is no limit. There's no minimum. There is no maximum on doing a conversion from a traditional to a Roth IRA account. Now, why would people not convert to a Roth? Not surprisingly, the reasons on this screen are just the reverse of what we just talked about. If you were someone who was closer to retirement and you were not really expecting any significant growth in the next few years in the asset values or the returns that you get, may not make sense to simply pay a large tax bill for doing a conversion if you're not really going to have much time for that money to then grow tax-free going forward. So the older an individual is, the likelihood that a conversion makes sense is less and less. Also, if you think you'll be in a much lower tax bracket in retirement, the tax rate will be lower in retirement, you don't want to convert now if you're a high earner and pay, say, 25, 30% in taxes when you do a conversion. If when you get to retirement age, you may be in a 15% bracket, you're going to pay dollar for dollar less by simply leaving that money in a traditional IRA account. Again, likewise, the inverse of what we just talked about, if your IRA account is inflated or expect the value to decrease over time, so maybe you've bought an asset and you think that right now it's currently overvalued and you expect it to dip, maybe you have a stock that you're holding, right now it's historical high, you think that it's probably going to go down, you don't want to convert that now and pay tax at a higher value. That stock's going to in turn just decrease. Again, if you don't have the available cash to pay taxes, there's a penalty for actually taking the money out of the IRA to pay for that. One question that just came up, and I think this will hopefully answer some of your questions. If not, I can look into it after the webinar is concluded today. But a question came up and said, will converting affect my eligibility for Obamacare subsidies? My guess on this, and I don't know for sure, but my guess is the answer is probably yes. And the reason is that when I was putting this webinar together a few years ago, I noticed that when people doing conversions, a lot of federal programs, the child tax credit, Medicare premiums, those eligibility and those rates are all based on your income. And when you do a conversion from a traditional to a Roth, that is simply lumped into you shown to the IRS as additional income that you had. It can make you ineligible for certain government programs. So I'd have to look in specifically if the Obamacare subsidies would apply as well. My guess is that they do. If the Obamacare subsidies are going strictly off of what your income is in a given year, then that's probably going to impact, if you did a conversion, would impact your eligibility for those subsidies. The other question said, what is closer to retirement? What age or time frame is, quote, closer to retirement? Not sure I can answer that specifically because I guess it is all relative. I was thinking more of individuals who may be 65, 70 years old. And again, part of that analysis, when somebody is closer to actually pulling money out of their IRA, is what kind of assets that they have. If I was 70 years old and I had $20,000 in my traditional IRA and I was coming up on an opportunity where I could make another $20,000 and kind of double my money, I might be willing to go ahead and pay the taxes and do the conversion at age 70 simply because my money was going to double and have all of that gain tax-free. So it's something, again, the age is relative also depending on the significant growth. But if you're somebody who is approaching the required distribution age, your assets are all your accounts are kind of safer investments, you're not experiencing as much growth, doesn't make sense necessarily to take a huge hit in doing a conversion. Again, the one thing to remember, though, is a conversion can be done on a partial basis. So even if I was 70, then I had most of my money in very safe investments, earning 3 or 4% a year, but there was an opportunity that I came upon that required just a little bit of capital that could potentially be very fruitful. I could always open up a Roth IRA and convert just a portion of my money from my traditional to a Roth and then only pay taxes on whatever amount I move over. It's important to remember conversion can be done in portions. And again, that's another reason to go talk to a tax advisor, maybe plan a strategy where if you want to have your money ultimately growing tax-free, come up with a strategy and a plan to actually convert all your money over another 5 or 10 year period of time and ultimately have those assets growing tax-free for you. So the bottom line on whether or not to convert, really everyone's situation is unique. And I wish I could be more concrete on that, but that unfortunately is the reality of the situation, that everybody has different ideas of what they want to do with their funds going forward, what they want to invest in, what kind of returns they think they would be able to get. But there are many conversion calculators. If you were to go on the internet and look for Roth IRA conversion calculators, where you can put in your account value, put in your age and other factors, Those calculators can help you make the decision on whether or not you should do the conversion. The key thing, though, with all those calculators is they do ask you to put in what your projected return you will have. Now, if you know kind of to a certainty at least, or a reasonable certainty, I should say, of what you would be able to get with those returns, then you can put that number in and probably give you a good idea whether or not it makes sense to actually do a conversion. But again, that's the problem with the calculators. They want you to put in that projected return. If you didn't have an idea or a reasonable idea, it's not going to help you a whole lot. Again, at Advanced IRA, we cannot advise an individual whether or not to do a conversion. That's really getting in more to tax advice. So we would encourage you, again, talk with your financial advisor or your CPA, have them help you make the decision, and go see those individuals prior to the end of the year so that you do not miss an opportunity to do a conversion. If it turns out that this year was a good opportunity because of your losses or your income, you may be able to make that conversion now, pay less in taxes, and have that money growing tax-free going forward. So we'll kind of spend the last few minutes here just talking about converting an asset in a self-directed IRA, which can be a little bit more arduous process than simply converting a mutual fund or an account simply holding cash. So what is needed in order to convert a traditional self-directed IRA into a Roth self-directed IRA? Well, first you would need an account application. You actually have to set up a Roth IRA. We need a conversion form for you telling us what exactly you're going to convert. We would need then a basically get an independent fair market value of the assets you wish to transfer. And then also there would be some kind of documentation required to actually transfer ownership of the asset from the traditional to the Roth. Now, as far as the Roth account application, you can simply contact our office or go to our website and get the most updated application. It's simply a matter of filling out the paperwork and telling us that you're opening up a Roth IRA account, and we certainly walk you through that process. Now, a lot of times when you're looking at doing a conversion of a piece of property, for instance, you may need to get the first step, get this Roth account open, get an account number issued, because you're going to need that when you go forward with the rest of the paperwork and the rest of the documentation. Our conversion form, again, also available on our website, or simply contact our office or contact your account manager to get that conversion. And this form just tells us what it is that you're converting. Are you converting your entire account? Are you converting just some of the cash, maybe just some of the assets that are in there? Just, again, telling us what exactly you want to have subject to taxes and what you want moved from your traditional to the Roth IRA. Now, the other two key pieces of documentation are things that you have to kind of acquire and get on your own. Obviously, the application and the conversion form we would supply to you. But again, in order to report to the IRS that you are doing a conversion, we are required as the administrator to give them a fair market value for the assets that you converted. Again, a fair market value is defined by the IRS, typically what a willing seller would pay, or a willing buyer would pay to a willing seller with neither under the obligation to ask. Or to act. Again, valuations should be provided by somebody who's independent and qualified. Okay, so if you're the IRA owner, even though you may be qualified, you are not independent. So you need to get a third party, somebody who's unrelated to you, to actually value that particular asset. Certainly a CPA, an attorney, possibly an appraiser if it's real estate, can also apply that required valuation for you. And we do ask that the valuation be done within the last 30 days or so prior to time of the conversion, so we're getting the most accurate value. Now, if you're converting mutual funds or stocks, that's much easier. There's a market price that adjusts minute by minute. So when you do a conversion of those types of assets, much different process, a little bit easier. But when we're talking about real estate and private notes or privately held businesses, getting a valuation done within the last 30 days is typically would be sufficient. Now, the documentation. Again, when you're doing a new stock account, if you were to call up your E-Trade representative, you have a traditional IRA and you convert to a Roth there, they simply open up the Roth IRA and move those stock holdings right over in from the traditional to the Roth account just within their system. It's a very simple process. There's nothing else you have to do. But when you are dealing with self-directed assets, like a piece of real estate or a note or a private highly held business, you have to actually transfer the ownership of that assets to reflect to all parties that that asset is now held within the Roth account, not simply within the traditional IRA. Now, with real estate, again, when we're talking about valuation, A qualified real estate appraisal would work. A promissory note, generally it's the fair market value of the loan plus any unpaid interest. If it's an LLC or corporation or partnership, usually the manager or president can supply a valuation. They typically are qualified, and most point they're independent of you or your IRA, so they would work as well. Any other assets, contact us for guidance on that. But again, the documentation is the last step to transfer the title from the traditional to the Roth IRA. Again, we cannot draft this paperwork. We would kind of deem drafting a deed in that situation or a note or assignment of mortgage as a legal step and something we can't do. So we can certainly give you a third-party reference if it's an attorney or someone to help you draft those documents, or if you want to pay that or do that on your own, that is up to you. Again, the key thing with this documentation is simply that a representative from Advanta must sign off on any documentation that transfers the interest between the traditional and the Roth IRA. And again, the documents that would require for transfer, if it was a piece of real estate, there'd be some type of deed, whether it's a quitclaim deed, warranty deed, be up to you as the IRA owner to decide what type of deed, but there would be a deed that's drafted where the grantor is your traditional IRA and the grantee is your Roth. You send that deed to us, we would sign on behalf of your traditional, then send it to be recorded. There should not be any doc stamps due. There would be probably recording fees to the local county. Those recording fees would be paid out of your IRA, but there would not be any transfer taxes for doing a conversion and moving a deed from the traditional to the Roth. Mortgage, you do an assignment of mortgage is the simple document. If you're holding a note that's secured by a piece of real estate, so you have that mortgage. The proper way to transfer the ownership of the mortgage from the traditional to the Roth is simply by doing an assignment. Again, a one-page document gets recorded in the county where the mortgage is held, and in advance if a representative would sign that document. Similarly with notes or LLCs or private partnership interests, a very simple and basic assignment would be sufficient. Whether you draft that, whether it's someone involved in the LLC or partnership drafts it, that again up to you. The key thing for us is to make sure that the document shows that the ownership is being moved from the traditional to the Roth. And then with a stock or maybe an account like a Forex trading account or a CD account, it's a key thing there is just making sure that that stock or that foreign currency account is re-registered into the name of the Roth IRA. With the stock, probably have to sign off an actual certificate, again, or at least work through the company that you're holding the stock in. Again, it's important that the deeds and the assignments of mortgages should be officially recorded, so that there's no doubt that this asset is owned by the Roth IRA going forward. The recording fees would be paid by the IRA account as well. That concludes today's webinar. My contact information is here on the last slide. Actually, we did have a question come up before we get into that. Is this the last and only year a conversion can be made, or can they be made in 2016 or future years? My certain guess is that, I haven't heard anything that conversions are going to be available for the foreseeable future. I have not heard any rumblings or suggestions that Roth IRA conversions this will be the last year. So again, certainly this year you could get it done by December 31st. If you miss that deadline, 2016 and future years, as it stands now, certainly you can do conversions going forward as well. Another question on the PowerPoint and the recording. We will certainly be sending a recording and a copy of all the PowerPoints, everyone who participated live, and certainly if you were watching this on a recorded version, you got that already if you weren't able to participate in our live event. If we didn't answer any questions that you had and you wanted to ask them kind of individually or had a certain circumstance, please give me a call. Here are my numbers on this last slide. You can also send me an email. I'll be more than happy to get back to you. If you need referrals to a CPA or an attorney, somebody else who can help you with doing the conversion and doing the paperwork that's required, certainly let us know and we'll make sure we get that to you. Please visit our website at advantaira.com. We have additional upcoming events and seminars, some of our live events in one of our office locations, or just other webinars like these are all available, all up for viewing on that website, and you can register for them right there. Well, I don't have any other questions, so at this time, I'll conclude the webinar. I want to thank everybody for joining and hope to see you at future events as well. Thank you.